Hello, this is Duncan MacDonald-Korth, editor of the Oxford World Financial Digest. I'm here today as part of our weekly video recap series, where OxWFD brings you the top stories of the week and then gives you its insights and opinion on them. It was another wild week in markets. All three major regions, including the US, Europe, and Asia, saw stocks move higher this week. The improvement in markets seemed to stem from numerous factors, not least of which was Fed official comments which showed internal divisions over policy. U.S. Treasury yields fell modestly on the week, with the 10-year now at 2.04%. In terms of news for the week, it was all about new U.S. economic data and Fed comments. Firstly, the U.S. Commerce Department reported on inflation and retail sales. The figures showed that retail sales rose just 0.1% in September, and that consumer prices actually fell 0.2% in September. Both numbers were taken as bad news about the economy, but ironically sent markets higher. This is because the data reduced expectations of a near-term Fed rate hike. Additionally, two Fed Board of Governors members this week publicly expressed concern over the economy, and said that they did not think the Fed should hike this year, directly disagreeing with Fed Chief Yellen. Most now see October as very unlikely for a rate rise, and even December is being given very low odds by the market. Many see 2016 as the next possible time frame for a rate hike. Third quarter bank earnings were a positive point this week. Except for Goldman's huge miss, earnings were not as bad as expected, which supported stocks. Oil saw a flat week of trading. The rally of the previous week ran out of steam, and this week positive sentiment was unable to take hold. The EIA said that it sees oil glut conditions continuing through the end of 2016. So what do we make of all this? Firstly, on oil, we think prices are going to stay right around where they are or fall. OPEC's production is running at fresh highs, and new Iranian barrels will offset any declines in U.S. output, according to the EIA. With the U.S. and Asian economies weakening, the demand side of the equation is only going to get worse. Thus, both sides of the market are now looking dim, so it's easy to see oil falling. Now on to the Fed and stocks. As we said last week, the good news for investors is that the stock market has made up its mind over whether delayed rate hikes are good news or bad. We are now back in the familiar post-crisis paradigm of bad news is good news. In our view, markets will take any bad economic data as positive news about delaying rate rises. We also maintain our position that the Fed will not hike this year, which we believe is appropriate given the macroeconomic backdrop. Best of luck to everyone, and make sure to join us next week.